I warned that Japan's debt crisis was about to hit global markets in a way most investors weren't prepared for. Almost nobody took it seriously. It sounded technical. It sounded distant. It sounded like something that only mattered to economists in suits. And then it happened. Japan's 30-year government bond yield surged to the highest level since those bonds have ever existed. Not one of the highest ever. And almost immediately after that, something even more alarming happened. The US Federal Reserve stepped in to support the Japanese yen. Think about how insane that is for a moment. The United States, the issuer of the world's reserve currency, intervening to stabilize the currency of another country. That is not normal. That is not routine. That is not everything is fine. This is no longer a future risk. This is not a what if. This is the moment where the system starts to creak loudly enough that everyone can hear it. And if you don't understand what's happening, your investments, your retirement account, your savings, all of it is exposed whether you realize it or not. What you are watching right now is the beginning of a global unwind that has been building for decades. Let me explain why this matters, starting with Japan itself. Japan is facing the worst debt situation of any major economy on Earth. Its debt to GDP ratio is now around 250%. To put that into perspective, the United States, which is already drowning in debt, sits closer to 120%. Japan has been running near zero interest rates for more than 30 years, effectively financing itself at almost no cost. For decades, this was treated as a permanent feature of the system. Japan borrows at zero, prints money, buys its own bonds, and nothing breaks. Investors around the world assumed this would last forever. But systems that rely on forever eventually fail. In late 2025, the Bank of Japan finally lost control. They raised interest rates to the highest level since the mid-1990s. The number itself sounds small, but the shift is enormous. More importantly, they stopped aggressively buying bonds and began stepping back from the market. That single change shattered the illusion that Japanese debt was risk-free. At the same time, Japan's government announced plans for even more spending, even more stimulus, and even more promises. Bond investors immediately revolted. Yields exploded upward at a pace that is statistically extreme. Moves like this are supposed to happen once in many lifetimes. And when bond investors panic, everything else follows. Here's where this stops being Japan's problem and becomes your problem. Japan is the largest foreign holder of US Treasury debt, owning over $1.2 trillion. For decades, Japanese investors borrowed money cheaply in yen and invested it in higher-yielding US assets. This strategy, known as the carry trade, was the quiet engine behind global liquidity. It was free money, or at least it felt that way. But the trade only works when Japanese rates are near zero. Once Japanese yields rise, the math collapses. Suddenly, holding US bonds no longer makes sense. And when that happens, those bonds don't get politely held to maturity. They get sold. That selling pushes US yields higher. Higher yields hit stocks. They hit real estate. They hit tech. They hit crypto. They hit everything that depends on cheap money. This is why markets reacted so violently the last time this trade even partially unwound. Bitcoin dropped more than 20%. The Nasdaq plunged. Trillions in value vanished in days. And here's the part most people still don't understand. Hedge funds piled into this trade with leverage. Massive leverage. Estimates suggest the total exposure could be many times larger than the actual Japanese bond holdings. That means forced selling doesn't happen slowly. It happens all at once. This is the spark, and the fire hasn't fully started yet. Now, let's talk about why this reaches into every corner of the global financial system. Most people think they're safe because they don't own Japanese bonds. That's a dangerous misunderstanding. If you own US stocks, you are exposed. If you have a pension, you are exposed. If you own a home with a mortgage, you are exposed. If you hold cash, you are exposed. Here's why. Modern markets are built on cheap debt. Tech companies depend on it. Real estate depends on it. Governments depend on it. When bond yields rise rapidly, the entire structure starts to shake. Normally, bonds are supposed to protect you. Stocks fall, bonds rise. That's the foundation of the classic portfolio. But when confidence in government debt itself is questioned, stocks and bonds fall together. That's when diversification fails. We are already seeing signs of this breakdown. Money managers are heavily positioned on one side of the market, fully exposed, with little downside protection. When everyone is on the same side of the boat, it doesn't take much to flip it. And Japan isn't the only risk. Europe holds trillions in US debt as well. Europe is under pressure to massively increase defense spending. That money has to come from somewhere. If European governments begin selling US Treasuries to fund themselves, US interest rates spike even further. This puts the US Treasury in an impossible position. Raise rates and crush the economy, or intervene and destroy confidence in the currency. Either path carries consequences. This is why central banks are panicking quietly behind the scenes. Publicly, everything is calm. Privately, emergency phone calls are happening. Statements are being crafted not to solve the problem, but to calm markets temporarily. Words instead of action. And markets are starting to see through it. When trust erodes, it doesn't come back easily. Investors begin asking questions they haven't asked in decades. Is government debt truly risk-free? Can central banks actually control outcomes anymore? What happens when multiple crises collide? That's why gold has been rising. That's why silver has been moving. That's why volatility is returning. These are not random price movements. They are signals. This doesn't mean collapse happens tomorrow. It means the rules are changing. It means the old assumptions no longer hold. And people who blindly rely on past models are going to be shocked. The most dangerous phase of any crisis is the moment when people believe it's already over. So, what does all this mean going forward? Let's break it down, because this is where theory becomes action. First, and this is absolutely critical, you have to understand that doing nothing is a decision. It's not a neutral stance. Staying fully exposed to risk assets, just hoping for the best without truly understanding the shifting ground beneath you, is not playing it safe. It's what we call passive risk-taking. You're making a choice to ignore the warning signs, and that's one of the riskiest choices you can make. Second, let's be crystal clear. This is not about panic. Panic is the enemy of smart investing. Panic destroys capital. It forces you to sell low and buy high. It clouds your judgment. This is about preparation. Preparation protects capital. The entire goal here is to recognize where pressure is building up in the system and to make intelligent adjustments before forced moves happen. You want to act, not be forced to react. So, where do we look for these pressure points? Start by watching bond yields. Think of them as the heartbeat of the entire financial system. Specifically, watch long-term yields. When they start rising too quickly, it's a sign that something is breaking underneath the surface. It tells you that the market is demanding a higher return for taking on long-term risk, which can put immense strain on governments, corporations, and homeowners. Next, keep a very close eye on currency markets. Currencies don't just fluctuate randomly. Sudden, sharp moves are powerful warnings, not just market noise. When a major currency like the Japanese yen or the US dollar makes a dramatic move, it's signaling a major shift in capital flows and risk perception. These are the tremors before the earthquake. In this kind of environment, defensive positioning starts to matter again. For a long time, it didn't. You could buy almost anything and it would go up. That era is over. Now, quality is paramount. We're talking about companies with fortress-like balance sheets, real pricing power that allows them to pass on inflation costs, and most importantly, genuine positive cash flow. These are the companies that can weather the storm. On the flip side, highly leveraged companies, the ones that binged on cheap debt, are incredibly vulnerable. Their survival is not guaranteed when the cost of that debt skyrockets. Now, you might think, okay, I'll just hold cash. But cash is not automatically safe either. It's a quiet loser. Inflation and currency debasement are like silent thieves eating away at your purchasing power day after day. This is precisely why real assets regain their importance during periods of instability. I'm not talking about speculating on them for a quick buck. I'm talking about using assets like gold, real estate, or commodities as a form of protection, a store of value when paper currencies are being devalued. This is also where patience transforms from a simple virtue into a powerful strategic advantage. When widespread fear takes hold, it leads to forced selling. People and institutions have to sell not because they want to, but because they have to cover losses or meet margin calls. This is what creates incredible opportunities. But those opportunities are only available to those who are liquid, calm, and informed. You need the cash on hand to act, the emotional discipline not to get caught up in the panic, and the knowledge to identify true value amidst the chaos. And let's put this into a broader context. What we are entering is not the end of markets. Markets will always exist. What we are entering is the end of complacency. The nearly 15-year era where debt was effectively free, where risk was systematically ignored, and where everyone believed central banks had a magic button to fix any and every problem, that era is fading into the history books. And if you look at history, transitions like this are always messy. They are volatile, they are uncomfortable, and they are filled with uncertainty. But they are also the precise moments where long-term fortunes are made or destroyed. The generational wealth transfers happen during these tectonic shifts, not during the calm, quiet years. The biggest mistake most people make in these situations is reacting far too late. They wait for the blaring headlines on major news networks to confirm what the markets have already priced in weeks or even months earlier. By the time the story becomes obvious to everyone, the damage is already done, and the best opportunities have already passed. Your neighbor telling you it's time to sell is the ultimate contrarian indicator that you should have been preparing long before. This moment, right now, is about awareness. It's about internalizing the fact that global finance is a deeply interconnected web. When one major pillar, like Japan's multi-decade debt experiment, starts to wobble, the shock doesn't stay contained. It travels through the entire system, from Tokyo to London to New York. Japan's debt crisis is not some distant academic side story. It's a major fault line running through the global economy, and the pressure along that fault line is undeniably increasing. So, what happens next? The truth is, it depends on a few key variables. It depends on how policymakers respond. Do they intervene aggressively, or do they let the market correct? It depends on how markets react to those policy moves. And most importantly, it depends on how prepared you are. Because one thing is absolutely certain in this uncertain world. Pretending nothing is happening, burying your head in the sand is no longer an option. The tide is going out, and we are about to see who has been swimming naked. The time for preparation is now. Thanks for watching. If you found this analysis valuable, make sure to subscribe and hit the notification bell so you don't miss our next deep dive. Stay informed, stay prepared.